Welcome to the Investing Show. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got our regular guest Richard Hunter, Wilson King Investment Management.
Hi Simon.
And I'm delighted to welcome to the Investment Show Keith Ashworth-Lord of the CFL SDL UK Buffettology Fund.
Good to be here.
Welcome to the show.
Thank you.
Keith, the first question has to be Buffettology. It's in the name of the fund. It obviously refers to a certain Mr. Warren Buffett,
Right.
but can you tell us a little bit more about what that whole line of thinking is about?
Yes. The name came about on a licensing agreement with David Clark and Mary Buffett, who had trademarked the name for their series of books about investing in Warren Buffett-style, both of them having lived in his house, basically. And we were given an exclusive. They'd known me for about 15 years. They were looking for somebody to manage a fund in Europe at that stage, not the UK. I narrowed it down to the UK. And the idea was that it would be run along the lines, the tenets of Buffettology, business perspective investing. They'd known me, as I say, for a long time, and they just said, you know, you're the guy, you walk the walk as well as talk the talk, how about it?
So how would you describe your style of investing then?
I'm a business analyst. I'm not a securities analyst or an investment analyst. I made that transition years ago, and all I'm trying to do is I'm trying to find the very best businesses I can according to a pretty well-defined formula. And what that formula is right at the top of the equation, I'm looking for an economic moat. Now, that's a Buffett expression, and what it means is you can defy the first law of capitalism, which is that excess returns get competed away to the cost of capital. And if you're consistently earning excess returns, it's because you're keeping the competition at bay, so barriers to entry. And what we look for, it tends to come across in certain key ratios, certain key areas. So we're looking for businesses that have reasonable growth potential, either in their markets or they themselves within their markets. But we come on now to some key things. We're looking for high profitability of sales, so operating margins, gross margins, but more importantly than that, we're looking for high returns on capital. So return on equity is an absolute key metric. We look for at least high teens return on equity, and some of our companies in there are doing 20, 30, 40, even 60% returns on equity. So very highly profitable on capital. But we're only interested in cash returns, so therefore we look very carefully at how much accounting profit gets converted into free cash. That's a key metric, and typically we won't be interested in anything that can't convert at least 80% of its earnings into cash over, say, a rolling 5-year period.
So that's the kind of business that when they put money into their own business, they generate good profits, and those profits are being backed by actual cash flow.
Yeah, the quality earnings, they're real profits. It's not some accounting jiggery-pokery. Consequently, most of our companies have very strong balance sheets. 2/3 of the companies in the portfolio, no gearing or minimal single digits. And we look for what I call businesses that are predictable to a higher than normal degree of certainty. And what I mean by that is that we know where those businesses are going to be in 3 years, 5 years, 10 years. We've got a roadmap for them that we can judge them against. And the last thing is management. You know, the number one job of management in my book is rational allocation of capital. And I like businesses that can reinvest retained earnings at high marginal returns to generate organic growth. If they can't, I'm not averse to bolt-on acquisitions where, you know, the classic 2 + 2 = more than 4. So new markets, new technologies, new products, or maybe synergy benefits. I hate with a passion mega acquisitions. I am very, very, very wary of those because they usually come to grief. And then the last point would be on the management. If they can't find bolt-ons and they can't invest in their own business to generate future growth and they're producing surplus capital, give it back to me as a special dividend so I can go and allocate that capital.
Does the whole dividend yield play into your thinking at all? Is it literally that last part of all the checklists that you go through?
It's the last part. I mean, because it's not an income fund as such, dividend yield is not a huge concern. Most, if not all now, of my companies do actually pay dividends. No, there's one that isn't at the moment, but most of them do. But it's really a secondary consideration. But having said that, Another sign of a really good company is that it can consistently grow its dividend. You know, and we've got in there a business called James Halstead, for example, 42 years unbroken dividend growth, 7 special dividends in the last 13 years. You know, those are the sort of businesses I like.
And would you tend to reinvest those dividends?
Yes, we would. Well, I say yes, we would. I mean, on the accumulation units, it would automatically be, but on the income units, the dividend income does actually get paid out twice annually to investors.
And one of the charges levelled at many fund managers is this suggestion of closet tracking, of if you're buying into a fund that's only doing what an index tracker would do for a considerably cheaper price, because it doesn't incur any of the expenses that a fund manager and running a fund management office does. If you can do that, and there's very little difference in the returns, then you should just go buy the index tracker. Now, your fund is clearly quite different to the index because you only hold about 30 stocks.
31
is that correct?
at the moment. That's absolutely right. It's a concentrated fund because once I've found a great company and I've found out I can buy it at a valuation that makes sense, to my way of thinking, I must invest a lot of capital in it. There are very few great businesses around, and when you've found one, make it work, invest heavily in it. So we've got 31 companies in the portfolio. We've got 6 FTSE 100s, 8 FTSE 250s, 7 small cap or fledgling, and I think we've got 10 on AIM, which vary from 25 million market cap up to 1.2 billion. So it's a waterfront fund, and it's not index hugging at all.
And is it harder to find the big companies that fit into what you're looking for? And does that mean that you find more opportunities amongst the smaller companies and the mid caps, or do you find them across the board?
This is a great question because one of the problems with the 250 and the 100, so the FTSE 350, is they do tend to be more covered by research personnel. And whilst I might find a great business in there, it's not always that I can find it at the right valuation, in which case it just goes on a watch list. Now, at the smaller end of the market, where the coverage is less, you do tend to find more immediate valuation anomalies and be able to get money in. But my watch list, I pick off companies on that, either a general market correction or maybe something company specific, and it gives me the opportunity to invest. We think MiFID II is going to be wonderful if it leads to blood on the streets among the analytical community, because it means a lot of these companies are going to have much poorer coverage, and we do all our own research in-house. We don't rely on brokers, and we think it'll help us to find more valuation anomalies.
And this is this EU, for our viewers, this is this EU regulation which says that fund managers now have to explicitly pay for research. Is that correct?
Correct. And our attitude is we don't want to pay for research. What we would prefer is to use the money to employ people who work exclusively for us analysts who are on the same tram tracks.
And Warren Buffett gets described as a value investor. His mentor, Ben Graham, gets described as the father of value investing. But those two people had slightly different approaches, really. When you look at what Warren Buffett does now, he'll tend to be happy to pay a higher price for what he sees as a quality company, whereas the classic Ben Graham, picking up pennies in front of a steamroller style of investing.
Cigar butt investing.
Yes, the margin of safety. Do you describe yourself as a value investor?
I do, but I don't make the distinction between growth and value that everybody out there makes, because growth enters into the equation when I'm judging the quality of a business, and value enters into the equation right at the back end when everything has passed muster on the quality of business. Only then do I look at the valuation, and I won't buy it unless I think I'm getting, paying a decent price for rather more in economic worth. But rather like Buffett, who was influenced by Munger, who in turn had been influenced by Fisher before him, Buffett will say far better to pay a fair price for a great business than a great price for a fair business, and I totally subscribe to that idea. So on occasions I will pay what I describe as a workmanlike price rather than a bargain price if I'm pretty confident about the future of the company.
Do you have any plans, or would you consider any plans to start moving outside of the UK in terms of investment? Obviously not to the US. I should imagine you might come up against some quality opposition there, but maybe in terms of Europe, for example?
What the twinkle in the eye at the moment is that at some point or other we might launch a global equities, which would incorporate US, European, Far East, UK. that's a twinkle in the eye, because at the moment we've got enough on our plates with Buffettology, which is growing well, and with the Free Spirit Fund that Rosemary Banyard manages for us. There's enough on our plate at the moment with those. But without any shadow of a doubt, this system, this business perspective investing, does cross borders. And I'm not going to bore you with them, but there's been 3 specific instances where I very nearly bought a US company for the fund. And for one reason or another, I didn't, and I wish I had, because it worked out well.
In terms of the businesses that you look for and the process that you go through, could you talk us through maybe a couple of companies that you've bought and you've thought have done well, and how those two things fit together, perhaps?
Yeah, I mean, this economic moat that I described before, we tend to get that from 3 real areas within the portfolio. That's not to suggest there aren't other areas you can find it, but the 3 that we get them from would be things like the human skills, human assets, which you can never see on a balance sheet. And a good example of a company there that's been very successful for us is RWS Holdings. It's a commercial and patent translator dealing on behalf of all the big multinationals in Europe and North America and the Far East. And it has, for that sector, it has a fairly unique thing in that the people who are doing the translations are dual qualified. They're a specialist in maybe technology or engineering or software or pharma or something like that, but they're also a linguist. So they'll take one, convert them into the other, or they'll take a linguist and give them a specialisation skill. And why that makes them different is other people aren't doing that. Patent attorneys are glorified lawyers, so they're dealing at the much smaller end of the market than multinationals. Next down is mom and pop firms with just a few people operating, and then you get freelancers, and these people just cannot get the skills, the skill set that a business like RWS had. And we first bought RWS for the fund at 80 pence, and it's currently knocking around £5. So that's been a great success. Yeah. And then another area we get this advantage from, this economic moat, is businesses that capture a piece of the customer's mind. And the absolute classic in there has to be Games Workshop. This is a business, they make little Tolkien-esque and futuristic gaming soldiers, and the paint and the scenery and the vehicles and the gaming manuals. And the people who do this hobby, predominantly males, late teens to late 30s, they spend their last dime on this. And, these guys, it's the nearest thing to legalised drug dealing on the stock exchange. I mean, they're absolutely hooked. Talk about a piece of their minds and a piece of their wallet with it. So that's been a great success, and one where patience paid off, because I was buying that at 373 pence to start with, right at the top when we started the fund, just like with RWS. And it's currently £23. And all of that gain, last summer, summer 2016, we were buying heavily at either side of £5 because we believed it was coming right. What they were trying to do to get cost out of the business was working. We could see that. What we didn't anticipate was sterling being such a boon to them. So that's another example. And then the third area is businesses that have some sort of must-have proprietary technology or know-how or product which might be patented, or it might not be patented. And the example I give you there is Bioventix. Bioventix is a little business that refines and develops monoclonal antibodies, high affinity antibodies. These are used in blood tests, and they bond with the antigen in your blood, and then the machine can read that you might have Vit-D deficiency or something like that. Their customers are the machine manufacturers, so the Abbotts, the Beckman Coulters, the Siemens, Roche, Johnson & Johnson, they're the big 5. And it's almost like an annuity income, because they take a royalty, typically 2% every time a test is done. More and more tests are being done, so more and more income is being racked up. And they have the beauty of, once a product is approved in the market, it's pretty well immune from being superseded by somebody else's product, because to get the regulatory approvals can take between 3 and 5 years on both sides of the Atlantic. So it's got a nice little barrier to entry, a wonderful, wonderful little business, and one that I say it's just must-have product.
Presumably, contrary to one of the 10 commandments, that the buy and hold forever, for example, have there been occasions when you've literally thought the company has changed tack, direction, management, I need to be out of this?
Sell discipline, number one, that is, Richard. Something has changed for the worse, and it ain't about to get better anytime soon. And that could be, like you say, it could be management, it could be technological disruption, it could be a competitive product, it could be regulation. An example of the last mentioned, regulation. International personal finance, we owned in door-to-door lender in Central Europe and in Mexico. They had a very hard time with a regulator in their biggest market, Poland, with caps on interest and finance charges. And as a result of that, it looked to me that if these were enacted, it would literally drive a stake through the heart of the business model. So that was one that we sold last December. It's not gone down particularly since, but we lost half of book value on that. It's the worst single investment in terms of outcome that we've had. But that's sell discipline number one. Sell discipline number two is I've got it wrong, and I will always get things wrong. I've got things wrong in the last 6-7 years, and I will get things wrong as long as I make decisions, because that's life. Just own up to it, admit your mistakes, and try and learn from them. Munger would say, rub your nose in it. And the only other reason we've ever sold is just on one occasion that we were fully invested, and I wanted to buy something, so I had to sell something to buy it.
And with the fund at the moment, do you hold a reasonable amount in cash ready for potentially for some form of correction that presumably is going to hit us eventually, because we haven't really had one this year at all?
Absolutely right. Not really have one last year either. The last decent corrections we had were in 2014 when we had 3 flash crashes and tail end of the year. I always like to have as Jim Slater would have said, the elephant gun loaded. To pick off things. At the moment we're running with about 15% cash, which is high. The reason it's high is not because I'm ultra bearish, it's because the flows into the fund have been so strong. In this last year, the fund in 2016 went from 25 million to 75, and then this year it's gone from 75 to 205. So the flows have been strong, and despite me investing the money, mainly buying more of what I already own, the new cash has built up. But it's great to have that cash. If we think back to 2014, I went into the first of those corrections in the August of that year with 18% of the fund in cash. We had one in August, October, December. Came out of 2014 with about 0.2% of the fund in cash. I used that correction as an opportunity to buy more. I would love a 15% correction to happen tomorrow. I really would, because I've got the firepower to take advantage of it. But it just doesn't seem to want to correct this market. It's extraordinary.
Just finally, because we're running out of time, the other question I was going to ask, of course, is investors, if they're choosing a fund like this, hopefully they're going to hope that it's going to do better than the market, and certainly your performance has been very, very good. But there will be years when it does worse than the market, won't there? If you've only got 30 stocks in there, there will be those years.
Yeah, there's been one so far, which was actually 2016, when we more or less performed in line with the market, but it wasn't one of these where we shot the lights out. I think we were up about 16% and the market was similar. The record on that, it's probably better to go back to when I was using this system to manage my own money, which was the 10 years before the fund was launched. And of 11 years there, 11 calendar years, my fund outperformed in 8 of them and it underperformed in 3. Overall, it increased, it doubled, more than doubled over those 10 years, and it was pretty well a lost decade for equities. So across the piece, it performed very well, but we did have 3 down years. But I should perhaps just say I was only running with about 15, 16, 17 holdings. So, almost double the concentration of Buffettology.
Yeah, because if there's sectors that you're not in and that sector suddenly does spectacularly well in one year, then,
We had it when the miners had a good year, because, we will never have miners. I'm not investing in holes in the ground. And that year, something rescued us, something made up for it. But it was a bad year. If you'd looked at it on the macro level, you'd have said, "Hey, Buffettology should have underperformed there because it didn't have these stocks in." But the other things in the fund, basically made up for it.
Keith, that's all we've got time for. Thank you very much for joining us. Richard, thank you very much for joining us.
Thanks very much.
Thank you very much for watching. Join us next time on The Investing Show. Goodbye.